Greetings and salutations, investors. In this video, we are going to be looking at easy margin examples for high yield monthly dividend ETFs. We're going to look at how margin actually works in an easy to understand format. I know there's a lot of head scratching out there as to how to truly think about margin, so I want to address that. I want to address how I'm using a margin in my own strategy, along with who margin is for, the guardrails I think that you should probably put up in place for it, philosophy, strategy, targeting long-term buy and hold investors with a relative passive mindset. So with all of that in mind, let's go. To understand what margin is, we first got to ask the question, why would anybody want to use margin? Essentially, it's just another word that means debt. Basically, the brokerage is lending you money. You can use their money to invest in whatever, with some restrictions in place, which is what we're going to get to. Now, maybe it's because you have a high conviction about a stock or an ETF that's going to go to the moon, or if you're an income investor, at least in my case, I am using margin specifically to elevate yield. For those who are not aware, for the past couple of videos I've talked about this. You know, my wife is pregnant with baby number 4. When baby number 4 comes in March of 2026, I want to take off a ton of time. But the only way for me at a portfolio size that I have, I'm going to be able to do that is to, one, jack up yield internally with basically my portfolio, the section that's non-leveraged, and two, is an external way or an external strategy of doing it, which includes margin. So for me, I'll get more into that in a little bit, but that on a base level is why I have gotten into margin. It's going to allow me to have a portfolio size to replace my wage while I take time off from work and really experience the FIRE lifestyle for potentially up to 18 months, and who knows, maybe beyond if everything goes well. Now that that's out of the way, let's talk about two important bits of information to understand how margin works. And I think everything flows from these two big ideas. What is margin, a margin requirement, and what is margin maintenance? So I'm going to have a couple of pictures here that I think help sort of understand how it works. So margin requirement is the money that you got to put up to get into an ETF, let's just say. So pick any number out there. It could be $10,000. Let's just say the margin requirement is 50%. If it's 50% on $10,000, you have to put up half of that, $5,000, to enter into that position. So if you can put up, if that number, it could be any number, just use any number. In this case, we'll say 10,000. If you want to invest $10,000 into what XYZ ETF or stock, then you got to put up $5,000, and the brokerage will lend you the other half. And that margin requirement could be 50%, it could be 30%, it could be any percentage that the brokerage sets. And they also do change it. Now, typically, because I'm going to be using Wealthsimple as an example, what I have noticed is newer funds typically get labeled with 50% right off the bat. And then as it has a little bit more time to settle, then the margin gets I haven't seen it gone higher. I've only ever seen it get reduced down to around 30%. So for example, I've seen this with BIGY from Evolve, which has a 50% requirement, and ECHI by Ninepoint has a 50% margin requirement. But I do believe those ones are going to come down as time goes on with those funds. So that's to get into the position. But then there's this other one called margin maintenance. So this is the money that you typically need it's basically your principal money that you need to keep inside of the fund in order to maintain the position. So whereas maybe it took 50% to get in, the margin maintenance is typically lower. So it might be, say, 25%. So if the value drops, say, to that 25% level, then you could potentially get margin call. But the idea here, and the big idea, is the margin requirement is your own money that you got to put up to get into the position. The margin maintenance is usually a lower value of what you got to keep into that position in order to not get margin called. And if you want to stay above a potential margin call, you might have to put in some more cash just to stay above that threshold. But every brokerage is very different. We are going to talk about Wealthsimple. They have a whole other way of doing this. So I'm kind of explaining more of to what I understand is how it generally works. But as always, feel free to put into the comments section anything that might have been missed, add some context, add maybe some information about how other brokerages work if you indeed use margin with other platforms. But I'm a lot newer to margin, so I'm going to do the best I can to just hit on the generalizations of margin. So that's typically how it works. Now let's go into maybe a better example, a more specific example of how a margin scenario works. So in this example, you'll see it's called the margin call scenario. Let's say you want an ETF. Like I said, pick any number, it doesn't matter the number. In this case, we're going to pick $20,000. The ETF has a margin requirement of 50%, meaning that you got to put up half the money to get access to the other half. So if you put up $10,000, then of the $20,000, then that'll give you access to the other $10,000. I think that's pretty, hopefully fairly easy to understand. Margin requirement, right? Put up half of the money to get into the position. Then there's a margin maintenance. Now in this case, it's going to be 30%. Like I had mentioned, margin maintenance is typically lower than the margin requirement, sometimes half, but every brokerage sets that out for themselves. I believe in Canada, a margin say requirement can't go lower than 30%, but the brokerages can go higher than that, I believe. So do your own research on that. I believe that as far as margin requirements, they can't go lower than 30%. As far as margin maintenance is concerned, that's kind of a whole other scenario as far as each brokerage is concerned. But at least in this scenario, margin requirement 50%, margin maintenance to stay into that position is 30%. Now, what you're going to notice about this example is that the total value started at $20,000, and over here it's now at $12,000. So that means it dropped, the value of that ETF or stock dropped by 40%. Now, what you're going to notice is that the money that the brokerage put up, that has not changed. Now, that makes total sense. They want to protect their assets. Yes, they're lending you the money, but don't think for a second they're ever going to let that money truly fall. They are going to get out whatever they put in, no matter what. All the risk is on you. Okay, so what truly drops is the equity you put up. So the equity you put up, which started at $10,000, is now at $2,000. Okay, so even though the total value dropped by 40%, your initial money that you put in dropped by 80%. This is where the issue and concern with getting into margin has extraordinary risks to it in a traditional format that we're talking about here. Like I said, Wealthsimple does it a lot differently that we're going to get into, where it has some rules that govern these examples, but you'll see it is different. So you went from $10,000 all the way down to $2,000, which is technically, as that stands, that's an 80% drop. To make things perfectly crystal clear, $20,000, 50% margin requirement, which means of $20,000, that is $10,000, and the brokerage puts up the other 15% on this number. You always got to start with that. What is the total number you're trying to achieve? This will help make things a lot easier to understand. What is the total number, regardless of the margin and the equity you're putting? What is the total number? This will help you understand margin requirements so much easier, at least I find. So in this case, you're putting up half of $20,000, 50%. Margin maintenance is one, as we discussed, below the margin requirement. This is the money you need to keep in the account in order to maintain that position. In this example, it went from $20,000, the total value went from $20,000 to $12,000, a 40% drop of the total. However, we know the brokerage, they're never going to let their money be devalued. They're always going to protect it. And a margin call protects whatever they put up. So that's why there's no change on their part. You risk losing everything. So even though the total value dropped by 40%, the money you put up dropped by 80. Okay, so of that $20,000 that goes down to $12,000, it is all your initial money, the money you needed to put up to get into that position. You sitting at $2,000, you are below the margin requirement that is 30%. Okay, because you put in $10,000, $10,000, you are going to need around $3,600 to maintain that position. $3,600 is 30% of the total value. So I think that is a more accurate way of describing it. It must be 30% of whatever the total value is to maintain a position. So currently, $2,000 of $12,000 is 16.7%. Okay, and to get to 30%, we need to inject another $1,600, which will then be 30% of $3,600 will be 30% of the total value here. And if you can't do that, then the brokerage will either notify you or give you some sort of notification. If the market's dropping quickly, they might just automatically sell it off and you have no say in the matter. So that is the danger with using margin, is that it sounds great on paper, but it carries some pretty severe risks with it. So with all of that in mind, knowing what margin requirement is versus margin maintenance, now we can start to look at some examples, some philosophy strategies, the guardrails, who is this for, and all of the rest of it. Now, I know many of you, and I think the topic of margin has really started to bubble up because here on Wealthsimple, a platform I use here in Canada, it's kind of, if you're an American watching this is the Robinhood adjacent, you can maybe, I guess, think of it, but it's certainly a more encompassing platform with tax stuff in it. You can do banking through it, of course, investing through it, and a whole host of other stuff. They're really building out the platform to be your one-stop shop. I would say within the last, call it, couple of months, they have been prompting investors to use margin. You get these upgrade your account. There's been like the summertime promotions to use margin or transfer a margin account. And they also just show you, if you use margin, this is how much money you would have available. So I think it's perking the interest of investors of all kinds. Doesn't matter if you're into cover call ETFs or you're a growth investor or a dividend investor. I think it just being able to easily see that number, it certainly makes you think a lot harder about borrowing money to invest. But as we are going to discuss, that has its risks, and it's certainly nothing that you should just jump into without a plan that you have conviction with and that makes sense and it'll help propel your goals. So having goals with this is really important. I think it'll help also manage risk a lot better. So as we had described with those examples I give, that's how, as I understand it, margin works with individual stocks and ETFs on other platforms. However, with Wealthsimple, they put a bit of a twist on it. And we are going to kind of abandon the language around a single position and look at it from basically the portfolio size standpoint. So currently, this is my margin account, a non-registered margin account. And I'm currently using roughly almost $60,000 in margin. Now it shows I have this max buying power. Now that I believe is based on portfolio size. So that would be what's linked to my buying power, which you see the little link here in the chain, TFSA, and the money I've put up in my non-registered margin account, plus the potential buying power equals this, I believe. So there's maybe some mathing to do there, but that's what I believe it to be. Honestly, I gotta say, I don't really care about this number up here, and I'm gonna show you why in just a minute. So it shows that my margin position is good, the health of it is good. Margin available to use is this right here. So once again, if you're curious like what this number is, I believe it to be TFSA plus your non-registered account or margin account plus the available margin that you can use. I believe that's what that is. Okay, so let's click on this to give us a better understanding and bird's eye overview of what's going on here. So it shows margin used is almost $60,000. It shows that with that margin between my TFSA and my non-registered margin account, with the money that I've borrowed, is $308,000 roughly. Okay. Now, I have other accounts, RSPs. I have my wife's spousal RSP with Questrade, but right now we're only honing in on what matters to the buying power, which is the TFSA and the non-registered. Now, why am I talking about both? Well, if you only use your non-registered margin account, your buying power is a lot smaller. You can use your TFSA to link it, and it gives you much more buying power. It also creates, as I understand it, it will allow you to borrow more, but in sort of a more stable, I don't want to use the word safer. I think I got to be careful about using a term like that, safer, but I think it allows you to borrow more against more of your portfolio. So it's just the proportion is so much smaller, which allows for basically more of a portfolio drop before a potential margin call. So that's probably the better way to explain it. I don't, especially with investing, you never want to guarantee safety or any language around something is safer, but that's probably the better way to think about it. How does it work with Wealthsimple? We have the portfolio value. Once again, that's the margin, non-registered margin account with the money I've borrowed, along with my TFSA. So this is the total rate here, and here's the TFSA size. So what you're going to notice is basically whatever I borrow, the margin requirement on the entire portfolio is this right here. The margin requirement. And essentially, it's almost like, I kind of think about this, it says the margin requirement, it's more like the margin maintenance. It's the amount of money I need to keep in my portfolio of my own money that it needs to stay above in order to keep borrowing that money. Another way to think about it is, as Wealthsimple says, basically it works like this. It works like this. As if your portfolio drops in value, your margin available, the money that you can borrow, will drop as well. Okay, now if it increases, your buying power, your margin available that you can use, can also increase as well. I think this is the more important number here. A lot of the language I've seen on Wealthsimple, as much as like Wealthsimple is a great platform, I just think that for the beginner investor, or I shouldn't even say the beginner investor, honestly, if you're a beginner investor, you shouldn't be using margin whatsoever. More or less focus on your registered accounts like your TFSA, RSPs, things like that. Think about maxing those out first before you even consider using margin. I just find the language is a little bit tricky to understand and navigate. I found it. I've been investing and I'm doing videos like every single week, and even for me it was a little bit tricky to understand, but that's why I find videos like this to educate you guys on really important, so you can at least build out some kind of framework around this kind of stuff. So at any rate, it basically, if your margin available goes to 0, that's when you're going to get margin called on your positions. But I mean, if you're focusing on just margin available, you'd be like, I know what the first question is. It's like, what is that even based off of? Like, how can I potentially even calculate how much I would use and how much my portfolio would drop by? But this is really the number right here. Margin requirement or margin maintenance, okay? It's in this case, it's sort of an interchange term. The big idea is the money that's yours that you put up between those two accounts, the value of your own portfolio without any borrowed money has to stay above this number. Now, surely we could certainly go down the rabbit hole. It's like, what is that based off of? But essentially it's 30% of the total value with even with the margin in there. It's roughly around 30%. So that's essentially what you got to stay above if you are going to be borrowing money with Wealthsimple. So just understand that it's going to be your own money plus whatever you borrow, and it's going to be 30% roughly, to what I understand. Of course, reach out to Wealthsimple. Ideally, I would love to do a video with them on just margin and maybe kind of add some context to this. I'm fairly newer to margin, so it's going to be important. I'll watch other videos and get some better ideas, not just Jordan did this, Jordan said that, so therefore I'm good to go. This is, again, just to help educate. There's certainly more to learn with margin and just investing in general. So stay above 0% or stay above $0, or really to think about it is stay above this number right here. Your buying power is based off of your portfolio value. It's based off of your portfolio value minus the margin you're using minus the margin requirement, and this is where this number comes from. Okay, so I'll repeat, is the portfolio value minus the margin you're currently using minus this margin requirement here gives you this amount of money that you can borrow to invest. So hopefully that clears up some stuff there. Now let's just chat about how exactly am I using margin? Well, since it's in a non-registered account, I'm focusing on Canadian stuff. I'm a Canadian, I live in Vancouver, BC. I'm using it for higher yields and tax efficiency. Now, if you're a Canadian investing in a non-registered account, the most tax efficient things you can invest in is Canadian stuff, because you won't be exposed to basically what makes up what are called the T3 tax factors, which is basically just a whole host of return of capital, eligible dividends, capital gains, foreign income, foreign tax withheld, other income. There are all these tax considerations, and the most tax efficient stuff would be if you only invest in Canadian stuff. That is not telling you to invest only in Canadian stuff, because you could potentially be missing out on some great opportunities outside of Canada. I have exposure to a lot of US stuff in my protected registered accounts that I don't have to pay taxes on, or in, say, RSPs, it's just deferred taxes down the road. But for me, I like knowing that this portfolio, I'm only going to be paying the most tax efficient stuff possible: return to capital, eligible dividends, and capital gains. And see, foreign income would be taxed at your, it's the worst form of tax, right? Taxed at your marginal tax rate, especially if you are a high income earner. But at least investing in Canadian stuff, you avoid that and you get more favorable treatment. So for me, I've basically invested, I've used roughly $60,000, and I've spread that $60,000 across all of these funds. They're roughly equal weight. So whatever 25% of that $60,000, what is that? Like, I can't, $15,000 would be that I've put of the margin that I'm using. 15,000 of that margin went into every single one of these funds. I get exposure to Canadian financials, life insurance, and other financial service companies, Canadian oil and gas, Canadian utilities, and then I got HHIS here for more concentrated exposure into things that maybe I don't have exposure to, like gold and railways, and then I kind of double up on, say, oil and gas. I'd kind of double up on some stuff in the finance sector. I get Shopify in there, which is great, because I can tell you this: I do not invest in Shopify in any other diversified product that I hold. So it's a single stock cover call ETF strategy that just gives me exposure to other spots in the Canadian economy, like uranium, that I otherwise wouldn't have gotten with ENCL, ULTY, and Bank, which are fantastic funds. I really like them. But again, do your own research for those funds. Don't just invest in something that a creator owns themselves. But for me, tax efficiency. I invested in these things, once again, into a margin account, because there's also the potential that I can also maybe write it off, all depending. There's still more research to be done on that, and I'll probably talk about that in a future video. Once again, throw any suggestions, context into the comment section below. As much as you participate in there, others who maybe don't know as much about investing that are looking to learn, you can learn a lot from the comment section in videos like these. So what are maybe some guardrails that you can maybe put up for yourself when using margin? These are kind of like internal laws or rules. You can think about them that kind of govern how and when you would actually use margin. I think I'll have more, but here are some of the guardrails I've kind of put in place for me. So the biggest one is, how much of my portfolio should I use for margin? Should it be 50%? Should it be 30%? As far as a percentage backed by your portfolio, or a percentage of your portfolio, I have gone for around whatever my yield is. That's sort of how I'm thinking about it. The idea for me was based on some past changes that I made, and you can watch my other videos, my recent videos where I talked about what I sell and buy and my portfolio sizes, and I kind of go into a bigger detail explanation of all that. The reason I wanted to bring forward a year's worth of distributions to put to work today, to get ready for 6 months down the road when I decide to take off all this time to be at home, to be with kids, to be with my wife, help out at home more, spend more time with my kids, and really experience that FIRE lifestyle, while also having the opportunity to build out this channel more and being able to do more content and connect with you all much more frequently. So that are some of my motivations. But again, I guess it's more not really a guardrail, it's just more of a philosophy as far as how much margin should I use. Now, I've done an interview with Todd talking about who I think is like the margin master. He uses margin at a very active level, and I want to use margin at a more passive level. I'm a buy and hold investor. Whatever I use margin on, I want to just hold for the long term. Todd's a lot more active. He can talk to higher level strategies. Certainly, this is a good interview. I think you guys should check out where Todd uses Yieldmax funds. He's using triple leverage, double leverage, ETFs. And he's writing his own cover calls and puts on stuff. So he's using it in a much higher active way than I will. I want to talk to more of the buy and hold investor who has a more passive mindset in mind. Okay, so that's really who I'm trying to target. But I had a question that I gave to Todd, and basically the question was for Todd, how much of your portfolio should you borrow, or how much margin should you use in relation to your portfolio? Todd, I forget exactly. It's someone basically his mentor, someone he's followed for a long time, basically said something around 30%. At that period in time, I did not have a number or percentage. So 30%, that works for Todd. That's Todd's maybe top end of risk tolerance for margin. For me, I want to go a lot lower than that. I want to separate myself as much as I can from a margin call. I believe my portfolio would have to drop by 60, high 60% in order to get margin called. So, if the market drops by that much, we got bigger problems going on. I'm probably not as worried about the stock market. Anyway, it's just create that separation. But that's for every individual to figure out for themselves. But for me, what I'm going to go with is just my yield for now. And maybe if your yield is 30%, 40%, then maybe at least to start, it doesn't hurt to start low if you're uncomfortable with it. Maybe start with 5% and then work your way up from there. But I don't know if you're gonna internalize my what I'm saying here, and you're like, okay, I'll just go for yield. I would suggest that maybe potentially, especially in the early going, maybe don't go higher than 20%. But that's more based off of my own risk tolerance. So anyways, you all have gotten a bit of a flavor for my portfolio, how I'm using it. What are some other maybe guardrails to put in place? As I had mentioned, if you are newer to investing, newer to margin, I would say just focus on your registered accounts. You'll spend more time researching the ETF stocks and more time in the market. And only when I would say that stuff is maxed out, get a non-registered account going, then maybe. But boy, it's a double-edged sword. It really is. It's really easy to get into it. It's like a click of a button and then you're into it. It's almost too easy. So I know I have the capacity to stay away from it. And I put my 16% limit, roughly, whatever my yield is, but it's somewhere in that range. And basically, I'm just going to let my portfolio grow, which is going to create more buying power, which means my margin to portfolio size ratio is also going to start dropping. I think the last time I checked, and even though I've only been into margin for a couple weeks as of the recording of this video, it's already below 16%. It's at 15.8. Now, if it continues to drop, I think I'm going to be much more opportunistic and maybe get back up to that 16% range in time, but only maybe now when it's quite clear that there are opportunities in the markets, maybe to average down some of these positions. Now, the next question might be, Jordan, when would you pay off essentially the margin I'm using? Right now, my philosophy is basically just to hold it. I think if I get to a portfolio size where it's not just supporting my lifestyle, but I'm also able to reinvest 30 to 50% of the distributions back into these funds, I think that's also a critical point. If I'm living off of these funds and it's supporting my lifestyle and I'm also reinvesting 30 to 50%. If I get to that point and the money that I've calculated is basically my own money that's able to do all that, then I probably just sell off whatever and reclaim and just get rid of the margin at that point. And honestly, if you have a portfolio that's doing just that, it's supporting your lifestyle, you're able to reinvest a healthy amount of distributions to keep it growing, and you're just dollar cost averaging. I don't really exactly see personally, if I was in that position, I don't really see a scenario why margin is even relevant, other than, right, it's a bragging right. It's maybe something you can post about on social media. Maybe you use it maybe for some fun money, but honestly, I just think I wouldn't personally want to use it for fun money to put on something else. I just don't think I wouldn't use it for that. I would say be very responsible with this. A lot of day traders use margin, and like 90% of the time, day traders lose out to the long-term, right, index investor of, say, S&P 500 type stuff. Anyways, but who knows? There could be all kinds of reasons why you want to use margin. I hope that a video like this can ideally give some context, help out how to think about margin. I see it as an amplifier towards my goals, especially in the short term. Having another baby, and which then basically stoked this idea of, I have the opportunity to take more time off from work, and it's job security. It really is. And I would 100% try to live off of these distributions, experience the FIRE lifestyle at my age of 35 next year. Well, I'll be 35 in December, but just to try it out and see what life is like on the other side. And I think it's worth it. So in order to get to that point, a portfolio size that will support me and my family, as I mentioned, margin is going to be a tool in that tool chest, along with getting into some higher yielding funds as well. But I've talked about that in my prior videos. So I really hope you all, I know this ran a little bit longer. There's a lot to talk about in this video. Hopefully you all enjoyed some context around investing with margin. There's certainly going to be more content to come. I would really love actually to do a video of questions you all have. So a video that's more specific to investor questions that I can address to maybe hopefully help with your own ideas, goals, and understandings of margin. But once again, margin is risky stuff, and don't get into it without a plan and something that you've thought about for a long time. When I started thinking about margin, it took me about 2 months to more or less understand what I'm trying to do, my goals, how comfortable am I truly going to be with it. And some of that just takes time. You might need to write it down, but spend some time to dwell on that. And hopefully you come to a spot where you have that conviction, you have that understanding, and that idea of safety, margin of safety, I should say, that would allow you to be comfortable investing in this. I know many of you are asking about it. That's why I'm trying to address it here. So with all that being said, hit all the buttons of like and subscribe variety, and I'll see you all in the next video.